Wyoming's Jackson Hole conference went online this year, where we had the US Fed coming out with the latest commentary and prospects from what their analysis of the current US economy had to say, as well as their outlook on interest rates, inflation, and where they believe the recovery story is currently at. Now, in what came as quite a support to equities, and as we speak right now, US equities are flying. The Dow is up 288 points. Futures, Dow futures I'm talking about, are also up around 200 points. So the street, at least right now, immediately after this announcement, and it's been a couple hours, seems to be cheering the announcement. Now, what was the key takeaway over here is that Jerome Powell, firstly, was the spokesperson who announced a major policy shift. And this was to average inflation targeting. Now, for us laymen, what it means is that the central bank will be further inclined to allow inflation to run higher than the standard 2% target before once again hiking the interest rates. So what's happened during the pandemic is, in order to support liquidity as well as provide support to the economy, the interest rates have been brought down lower and are at the lower end of their historic averages. What happens is, once the economy recovers, usually we see an interest rate hike. We might also see inflation. What the Fed is now saying is that inflation may well rise above the 2% mark, but as long as it is in check. Now, there's a bit of gray area as to what they mean as with in check, because in check might mean 3%, 4%, they didn't really say. But according to them, as long as it's above 2%, which is the standard, but within permissible limits according to them, they are willing to let interest rates stay where they currently are. That means no hike in interest rates coming anytime soon. So usually what does low interest rates correlate with? Good performance in equity. So it seems that that's what's playing out right now in the US market. Instantly after this announcement, the market seems invigorated. Whether it'll hold throughout the rest of the trading session is a different matter or not. We'll have to take a look at how the US handover was tomorrow morning. Now, what's important about this decision by the Fed is also that it is a reversal of sorts from the historic view that we've seen. Whenever there's low employment, it can lead to a spike in inflation. So historically, the Fed has always worked towards keeping inflation in check when employment rates are low. Now, given that the economy seems to be on a recovery rate, the economy seems to be on a recovery path rather, and that while the unemployment rates are still abysmal, we have loads of other macro indicators like retail sales that have really improved, or whether it be industrial output, or whether there's a whole host of macro indicators lately that have been coming out that point to green shoots and recovery. Now, in an environment like that, with inflation above 2%, you might make a case that it's time to hike the interest rate. The Fed, however, has said no, that is not what they'll be doing this time. They'll be breaking the traditional approach and leaving interest rates where they are. Now, apart from this, what they've also done is change the employment focus towards those who are on the lower end of the income band. So that's another thing as well that is keenly looked out for and well appreciated. And finally, just two comments to really give you a perspective for what Jerome Powell means by doing this decision. What he had to say is that many find it counterintuitive that the Fed would want to push up inflation. However, inflation that is persistently too low can pose a serious risk to the economy. So that's just something to leave you with and ponder your thought on. But for now, Fed maintaining its broadly accommodative stance for the economy.